Just to let you know, so after last month with Robert Blanco on immigration topic, and also our special event last week with movie director Ben Stassen and his latest animation movie that was a tremendous hit on Netflix. It was #1 animation movie. You can see everything on replay on our YouTube channel as usual, and we encourage you on following us on LinkedIn, Facebook, and other channels. So first to start, a little bit fresh news, as the deadline for tax filing has been postponed to May 17th for individuals, in case you have not seen it in the last days. And today we are very happy to have with us John Forry. He is Managing Director at in International Taxation and Infrastructure Advisory at CBIZ MHM LLC. John has more than 45 years of practice in international finance, investments, and taxation, including service as a business consultant, legal, and tax advisor. He's also professor at several university graduate schools around the world. He's graduate of Amherst College and Harvard Law School, and has authored many books and articles on those topics. He's also member of GPSLA, a group of dedicated professionals and service providers for international business individuals investing and relocating to Los Angeles. John will talk today about tax changes here in the US that are likely to happen in 2021. And we have already received a couple of questions by email that you sent to us in the last days. So John, thank you for being with us, and floor is yours.
Thank you, Alain, and welcome everyone. I'm happy to be here again. I think I appeared somewhat on one of your earlier broadcasts, but that was back in 2020. Now, obviously, we're facing some pretty exciting changes in US taxation. I think, Alain, if you would start sharing your screen with my slides, and I'll just give you a signal when I'm ready to move to the next slide. Okay, well, I think that one's pretty easy to see. Okay, and I think you've already explained all of these things. So let's go to the next slide, please. All right, so I thought, well, when you're dealing with people who might be coming to as individuals or foreign businesses to the US or are already here but are, having to deal with the changes that might come up, where are the key impacts of these likely US tax changes going to be? I think the most important ones that we'll cover here, together with a few others, and then the planning for those changes, are the US corporate tax rate is probably going to change, very likely. Also, income from foreign production and foreign investments. Many people who move here or businesses that come here also have, of course, foreign operations, some of which they continue to control from the own and control from the US. And finally, it would be planning for foreign individuals and businesses that are arriving or planning to arrive in the US, let's say during 2021. Let's go to the next slide, please. Okay, so there are a few examples of proposed changes. As I've said, the new US administration, as you probably are well aware, has ambitious plans to change federal taxes. Some of these examples include an increase in the US corporate tax rate from 21% to 28%. I think it's highly likely that that's going to occur. In addition, in the area of foreign income or income from foreign production, the previous administration created tax benefits for U.S.-based businesses that essentially own foreign corporations or provide foreign production, which they then bring back into the U.S. market. And so one of the particular important benefits, and this was designed, why? To encourage U.S. businesses to stay here and not feel that they have to move to a foreign country in order to get reduced taxes. Because the U.S. tax rates were 35% before the Trump administration. They went down to 21. And that is definitely a competitive rate with other countries. But the administration also wanted there to be significant tax benefits from the U.S. for foreign-based, for foreign operations and foreign income of those U.S. businesses, so they wouldn't have to move abroad to get away from U.S. taxes. So the U.S. tax rate on one category of income, very broad category of income, from foreign corporations owned by U.S. corporations, was cut in half. Instead of 21%, it became 10.5%. So that's a very significant benefit. And unfortunately, under this new administration, there's strong discussion about increasing that rate back up to 21%, or maybe even all the way up to the 28%, which is the new corporate tax rate for domestic income of domestic corporation. So this, you might say, well, why not just eliminate the exception? There's a lot of technical rules that are already in place. It's very possible that they would do this simply as a rate increase to bring it in line with other corporate income tax rates. The second change involving foreign activities would be for income from foreign production by U.S. businesses. Well, what? For sale back into the U.S. For example, some years ago, when an attempt was made in Congress to impose special tariffs on foreign produced products coming into the U.S., one of the targets was Taiwan production companies, because there's a lot of electronic production over there, very high quality and so forth. And it was discovered when they ran the economic impact of that change, that over half of all the imports from Taiwan were by US-owned Taiwanese companies. So in the end, it was decided it wasn't really a good idea to impose special tariffs on them. Well, this is a different approach. This says if you're a US business owning a foreign manufacturing facility, and that facility manufactures products for sale back into the US, not only will those product sales be taxed at the regular US corporate tax rates when they're brought into the US and resold, but there'll actually be an extra rate, an extra 10% tax. So instead of hypothetically being 28, it would be 38% income tax. This is designed not to encourage US businesses to own and continue to own directly these foreign operations, but instead to discourage, penalize US companies from setting up or using production facilities outside the US. Let's go to the next slide. What about individuals? So far, there's not been a proposal to significantly increase individual tax rates at the federal level. Right now, we're running at 37%. That maximum rate could increase back to 39.6%, which is what it was under the pre-Trump administration. But more importantly, there probably will be significant reduction in deductions that individuals can take from their taxable income. This has already occurred under the Trump tax reform, where tax rates were dramatically cut, for corporations and stuff. But the trade-off was that there were a lot of deductions from taxable income that were taken away. Many individuals probably are well aware that even though the tax rate went down a little bit to 37% in the Trump administration, their tax went up because many deductions were no longer available. This is about to be pursued again. The second main change to be aware of, proposed change, is that the long-term capital gain rate, which presently is 20% plus the Obamacare investment income tax of 3.8%, so a total of 23.8%. That would increase under the new administration for high-income individuals up to over 40%. This is not too favorable because it would essentially mean that capital gains are taxed at least as high for these people as ordinary income. So that the whole policy reason for having lower rates on long-term capital gains is to encourage people to invest in long-term capital investments rather than having the money available to them on a daily basis. So this could have significant impact on capital investment by individuals. The final remaining changes I want to mention are essentially affecting the gift and estate tax exemptions. You know that US citizens and also foreign individuals who are domiciled in the US are subject to worldwide taxation by the US as to any gifts or inheritance that they make. In our country, unlike many foreign countries, the gift tax and the estate tax are actually imposed on the donor, not taxed to the donee. In civil law countries like Belgium, most of the taxes are on the recipients. In this case, we have a single exemption, lifetime exemption right now under the previous administration's tax reforms for gifts and inheritances combined during your lifetime of a little more than now $11.5 million per individual, or almost over 23%, $23 million for a married couple. The new administration is proposing to take these exemptions back to probably their previous maximum of $3.5 million per individual. Quite a significant change. In addition, the assets in excess of that exemption would be taxed at approximately a 45% rate, which is somewhat higher than the previous administration rate. And rather importantly, the people who inherit assets, who normally under our code for decades, really almost since the beginning of the Internal Revenue Code back in the 1920s, normally they inherit assets at the tax basis equal to their fair market value at the time of the decedent's death. These rules changes would say that tax basis remains, even though there's been a tax, the tax basis remains at the tax basis of the decedent. So property that may have been known for 20 or 30 years, may be purchased at a very modest price in the past, that will be the basis in the hands of the new owner, the new heir. So disposing of that asset later, or depreciating it for business use purposes, we'll use a much lower tax basis. Let's go to the next slide. So how do we plan for such changes? Well, the changes will have very broad impacts. But when I think about what individuals from abroad or businesses coming into the US from abroad might consider, either doing in the future or actually undertaking now, first would be to consider decontrolling foreign assets. This would be by sale or gift or setting up joint ventures with foreign persons. If you can do that before you take up US residence or domicile, it's even better. But but even as to existing foreign assets. Why? Because the taxation, as I mentioned before, of foreign income held through foreign corporations and so forth, will be frequently now subject to a higher US tax rate. And the thought would be to decontrol some of these foreign assets by having them owned, for example, by a joint venture foreign corporation, which is not majority owned by US persons. A second possibility is to use this kind of foreign joint venture entity to hold foreign, doesn't matter on US, but to hold foreign IP and foreign business operations. So if you've got active business income, or if you have some valuable IP, which is going to be embedded in products manufactured with it, or contributed to a foreign business that's going to use it in its business operations, consider doing that in an entity, a foreign entity, jointly owned with other foreign investors, not simply owned or controlled by US persons. Okay, let's try to go to the next slide. A third area, this is a very broad bullet actually, even though it's very short, is to say, how do you capitalize a US business? Can you, for example, set it up in such a way or change it in such a way that the capital in it is essentially provided by the assets in it are provided by purchase or license or financing provided by foreign parties. And the reason for that is, of course, that it's usually possible to structure, for example, payments for property purchased from a foreign person, or license royalties to a foreign person, licensor, or financing, that is loans from a foreign lender, to allow for the payments, much of those payments, to be free of US tax, but still deductible by the US business. And that depends, in most cases, it will depend upon there being to take the example of financing. If the foreign lender is not a foreign bank or a US bank, if it is lending money to the US business and the lender doesn't own 10% or more of the US business itself, then the interest payments on those loans are not subject to US withholding tax. There's not the regular 30% withholding tax on interest, royalties, and other fixed or determinable annual or periodical income does not apply, even if there's no treaty involved. You don't have to rely on the US-Belgium treaty or anything like that. That's just an example. Okay, then the last thought is to deal with the US gift and estate tax as being having a reduced exemption, higher rates, and a lower tax basis being passed on. Try to use US trusts and other structures. We obviously have long-standing vehicles for individuals to structure their gifts and estates so that, for example, by using charitable remainder trusts, or by using entities that use, for example, life insurance, which is funded by loans obtained from third parties to cover the tax liabilities in the case of an estate. So they're numerous. I mean, this is a very broad area, but those devices are available to US persons, and they should be used by people who become US persons or US domiciliaries by moving to the US. Okay, this has been a rather quick tour of that, but Elaine asked me to stay within 15 minutes. I think I succeeded at that. But we do, I guess we have some questions. So If you have some that have come in or you have previously received, Elaine, please let me know and I'll try to address them.
Yes, thank you very much, John. So yeah, we have received a couple questions that have sent to you. The first one was related to the 180 days rule from a person with a B1 visa that were coming to the US on a regular basis.
Mm-hmm. So the thought, I think, in this questioner's mind is rather than coming for short stays, which are very impractical now, have been impractical, but just because of the COVID restrictions on travel, but also just going forward, the mechanics of going back and forth, short visits. Can that somehow be eliminated? Would it be possible for someone to stay here for longer periods? And the short answer is no, but potentially yes. Right? Good answer for a tax lawyer, right? So the no part of it is that even if you have a non-immigrant visa, a B1 or an L or something like that, you're still subject to the substantial presence test to which the questioner alludes. And that is if you spend a total of 183 days or more in the US during the current year, but also counting a third of the days from the prior year and a sixth of the days from the second previous year. If those all together add up to 183 or more, then at that point, you are treated as a US resident for income tax purposes. The normal formula, just to avoid that situation, is that you can, on a repetitive basis, year after year after year, you can spend up to 121 days a year in the US. And if you add up the current year's days, plus a third of the prior and a sixth of the prior, you don't reach 183. So many people do that. I mean, and even this questioner, you could stay here for essentially 4 months almost. Depending on which months there are, some has 31 days instead of 30 days, so you have to be careful about that. And not worry about this substantial presence test, not an issue. But I think what's inherent here is the idea of exceeding the substantial presence requirements or limits. What could you do? And we have two very valuable exceptions to that. And I think this questioner kind of postulated one of those situations by saying, well, you've got all your assets in Belgium, for example, and maybe all of your other activities. I mean, if you went to school somewhere, if you have a family somewhere, et cetera, they're not with you here during that period of time. So the short answer is we have a statutory exception which says that if you have closer connections to a foreign country, not just all, but some particular one, than you do to the US, then you can file a non-resident alien income tax return and claim the benefits of that exception and state the facts that support your compliance with it. The statutory exception for these closer connections doesn't apply if you have taken any steps toward obtaining a green card. So if, for example, you're going to proceed under an EB-5 program, or you have an L visa, but you're applying to convert it to a permanent resident visa. Any of those kinds of steps would make this exception not applicable. The second possibility, which is certainly available with respect to income tax treaty countries like Belgium, is that our income tax treaties have had for probably at least a couple of decades, and over than that, actually about 30 years, the new treaties have incorporated the similar type of exception for closer connections to the treaty country than to the United States. And the interesting thing about that, and anyone can look up let's say the US-Belgium tax treaty and look under the the article, which relates to so what's called a treaty tiebreaker on residence. Anybody who meets those tests can claim that exception by filing it with a tax return for a year in the United States. And it won't matter if they've applied or taken steps toward obtaining a green card. So once they get the green card, that's it. You know, if you're physically present in the U.S. with a green card, you're now a resident. There's no override for that. But this is a very well thought question. It's a very legitimate technique to use.
Thanks, John. Yeah, very interesting, because it's a question that we have had, you know, a very large number of times, and also it comes from probably a confusion in the words, in the residency words. Some people make the confusion in immigration residency and tax residency, which is very different. You can be one but not the other. And it's very interesting to understand that it's a difficult topic because there are many variables.
True, but a good U.S. immigration lawyer, in setting up a structure, let's say of B visas or L visas or whatever, will know about the difference. They know that there are differences, and will encourage. I mean, often I'm brought in to work with the immigration lawyer advising the client in order to make sure that you get the maximum tax benefits at the same time as you're getting what you need in terms of immigration benefits. And this is one of those examples. Yeah.
Right. In the question previously received, there was also a question on inheritage cross-border in between Belgium and the US. If you can say some word about that.
Yes, that is a two-part question, and I'm sorry to take so long to answer them, but it's an opportunity to explain some important rules. The question says, I have an inheritance pending from Belgium and was wondering if I will get taxed if I move any of that money to the US. The news here is pretty good. Inheritance or even a gift by a US person from a foreign person involving foreign assets is essentially not subject to tax by the United States. We don't have a tax, as I mentioned before, on the recipient of a gift or the recipient of an inheritance. Our taxes are imposed on the donor or the decedent's estate. And if the donor or the decedent's estate is out of the US and there's foreign assets involved, there's no tax on those transfers. Gift transfers also can involve US assets, notably bank accounts or intellectual property or something like that, because intangible property gifts by a foreign person to a US donee are also not taxed, US intangible property. Inheritance isn't so lucky. If this inheritance were an inheritance of US real estate coming from the foreign decedent, that would be subject to tax, but that would be taxed, by the way, to the foreign estate, not to the recipient. But of course, the asset is available to settle the tax. So the person who's receiving it would want to know that either the tax had been paid or that there was some reason why it wasn't taxed by the US. One of the reasons it might not be taxed by the US, if there is US real estate involved, is if that real estate was owned by the decedent through a foreign corporation, then what's passed to that person's estate is the shares of the foreign corporation, which is not US property. So short answer is you could still probably structure it around it, but that's not a process that the heir can accept or take advantage of unless the decedent already took advantage of that structure. But in general, there shouldn't be tax on inheritance of foreign assets from a foreign estate. The second part of that question is, I think, maybe I'll go ahead and ask it since you hadn't got to it yet, It says, if I sell a property in Belgium to buy one here, can I move those funds to the US without getting taxed or penalized? I'm a dual citizen, so that means Belgian and US. All right, so the US side of this would depend upon whether the property, when it's sold in Belgium and then used to buy a US property, that would depend upon whether that could qualify as a tax-free exchange of like kind real estate, which we have in the US. The difficulty with this scenario is that like kind exchanges generally don't apply for US purposes to exchanges of US and foreign property. So if the foreign property is what's being sold out and then exchanged into US property, or if the property is US property but exchanged into foreign, in either case, the tax-free exchange rules don't apply. They apply to US exchanges. So in general, the sale of property in Belgium would be subject to tax, I'm sure, by Belgium, but then there would, the person is here as a resident, or as a citizen, I should say, then there would be a US tax. Generally speaking, we would give a foreign tax credit for the Belgian tax, because that's where the property is located. We generally defer to the foreign source jurisdiction in order to give a foreign tax credit. That's
very interesting topic, long topic, because it depends on many factors.
Yeah,
so,
right. But the answers can be gotten fairly quickly, as you can see. You just set up the facts, and the answer will be pretty clear to someone who works in this area.
Yeah, right. We have received during the webinar 3 questions. The first one, it's an extension on those 183 days due to travel restriction. So a person that has spent more than those days, and they ask, so does the treaty free you from US taxes, or are you splitting the days in between Belgium and the US because you have spent more than 183 days due to travel restrictions?
Okay, right. So we had an extension of the time you could spend in the US during 2020, but that was a one-time extension that didn't apply to days beyond that. So, and those have not been added to. So it would be very helpful for someone to take advantage of the closer connections exemptions if they've had to stay longer.
Okay.
You can always explain that. By the way, there's aside from travel restrictions, which was subject to a very specific extension, amount of time, there's a general extension. If you have to stay for medical reasons, can't travel for medical reasons, that's not time limited. In other words, you could be here for a long time to get medical treatment, and you're not permitted by your doctors to travel.
Yes, and I guess also in the answer you made earlier on the same topic, if you can claim that you have your center of interest, your family in Belgium, etc., then the 183 days does not apply systematically. So
that's correct. That's correct. You just need to bring forward the facts and if you look at the treaty, or you have an advisor look at the treaty, you'll see that there are very specific factors that are listed. Where's your principal residence, physical, where you have a house, where are your connections like bank accounts and memberships in clubs and professional associations and all that. So you pull together enough information that you can put onto your tax return when you make that election.
Excellent. And that answers, I think, the following question on where can I find more information to claim the closer connection and determine if you apply. So it's inside the treaty itself.
Right.
So the Belgian-American tax treaty.
You can send an email to Alain, he can forward it to me, and I can answer or actually, extract the provision and send you a copy of it. It is true that tax treaties are a little bit tricky. If you go online and say, give me the US-Belgian income tax treaty, it'll give you the original treaty, and it'll give you a whole bunch of so-called protocols which sort of add up, and they don't, you have to do a fair amount of cross-referencing to see exactly what the actual final version is. But anyway, yeah.
Right. The next question is about retirements. The person asked, if a Belgian citizen living in Belgium, so I guess after years in the US, and transfers the total amount of a traditional IRA based in the US to Belgium, does he has to pay tax in the US?
Yes. we do have, probably most people know that we do have what are called Social Security totalization agreements with many countries, and I think including Belgium. But that really has to do with someone who's getting government retirement benefits equivalent to our Social Security or government retirement benefits in Belgium, let's say, and they move from Belgium to the US, right? Will they be taxed by the US on those retirement payments? Generally speaking, no, on most of those agreements. But that doesn't apply to things like private IRAs and stuff like that. And the IRA trigger is taking it out, as you probably know. You could leave it in there. In other words, it doesn't disqualify it as an IRA because you've left the United States. It doesn't change that. It would change your ability to add to the amount in the IRA because you're no longer a US person. But the IRA itself doesn't somehow explode just because you leave.
Right.
If anything you take out of it will be taxed. And what will happen is whatever institution is legally required to carry that, maintain that account will apply a withholding tax on it when they make distributions.
Excellent. I don't see any further questions for now. Yes, last one that just arrived. So the question is, I'm a Belgian citizen living in California full-time with a green card. My mother is living in Belgium currently. I'm her only heir. Would I have to pay inheritance taxes in Belgium when she passes away? She owns her house, so that's real estate, and has bank accounts. So the question is on paying inheritance taxes in Belgium when the recipient is US permanent resident.
So I'm not a Belgian tax advisor, so I'm not licensed to give answers on Belgian tax. My understanding is, however, that certainly if the assets are in Belgium, then what's happening there would be the tax on the heir under Belgian law, not on the estate as under our law. That Belgium would apply its tax on that heir, even though a foreign person, but if the assets are in Belgium.
Yeah. Okay.
Yeah.
And I think that was the last question. If you have further question, I've already put in the chat the email and phone number of John. If you want to ask further question, you can always also send them to me. I think that concludes our webinar of today. Thanks you very much for participating. Thank you so much, John, for giving us all your views on that very complex topic. And we will see each other in another webinar further than the past. And you can always follow us on social media and get the replays on our YouTube channel. Have a great day and see you soon. Bye-bye.
Thank you, everybody. Bye-bye.